As 2023 draws to an end, we have a ton of articles discussing their top dividend stocks for the next year. We have the 3 no-brainer dividend stocks for 2024. We have 5 amazing dividend stocks to buy for secure income. We have 3 magnificent high-yield dividend stocks. And we also have a few more articles discussing their no-brainer dividend stocks to buy in 2024. In today's episode, we're going to run through the 4 most common stocks that have been bought by investors in anticipation for the 2024 market. We're going to run through each one of these companies. We're going to take a look at them in our valuation model. We're going to get to our intrinsic value of them and get to our acceptable buy price given our investor margin of safety, and discuss whether or not we believe these stocks that investors are buying are ones that we should be looking to include in our portfolio. So jumping firstly to the first stock that investors are buying, it is 3M Company. Now this is one that I do hold in my portfolio. It is currently year to date down 13%, and we can see it is in the midpoint of the 52-week range with a current yield of 5.64%. Now, if you've been holding this over the last 10 years, you would be down on your position by 24%. And we do see its essential 10-year high at $259 quite some years ago. So let's take a look at the metrics behind the company. We can see the dividend safety score of 40, meaning it is unsafe. Market cap 59 billion, a large cap company. Now, in terms of recessionary metrics, for those that see a recession inbound, while they increased the dividend during the 07-09 crash, they pretty much had average growth of companies in the S&P, and also they had a near recession return of the S&P at negative 54 versus the S&P 500's negative 55. Now, dividend growth was incredibly poor this year at less than 1% in February. Last 5 years, however, they did increase it by above that inflation that I advocate on the channel of 4% or more. And over the last 20 years, 8% on average. So it hasn't been too bad over the longer term, but more recent, it hasn't been the greatest. And one thing to note is they are a dividend king, having increased those dividends by 50 years or more consecutively. Now, dividend yield theory, for those that are new, states that the company is undervalued when the current yield sits above the 5-year average. So this is one sign of undervaluation. But bear in mind, we don't look at any of these models in isolation, and we do draw our conclusions towards the end of the episode. Likewise, forward PE, another sign of undervaluation at 10.9 versus 17.4. Now, when we look at the sector PE, it is significantly lower at 10.9 versus the industrials of 19.6. Now, in terms of the free cash flow payout, remember, earnings is here. It is susceptible to manipulation by management through accounting, so we focus on the free cash flow. Personally, below 60% is my own preference, but different people will have their own. I see it, if it is below 60%, I believe that management do have that ability to offer those double-digit increases we love to see as investors. Now, 2022 was 88%, hence why we can understand why they did have that very minuscule increase. They were probably looking to keep up their dividend king status, but they increased it by 0.7%. 2023, it is expected to come down to 68%. So for the 3M company, I would like to see this company give at least an inflationary increase in 2024. Free cash flow per share, pretty inconsistent, 609 in 2013. If you looked up to 2021, it was increasing, although inconsistently. It did drop significantly in 2022, but in 2023, it is expected to increase up to 877. Now, sales growth, we like to see a minimum of 3 to 7% just for that steady, moderate growth. At least 3 to 4% to keep up with inflation on the top line. Very inconsistent. 2022, negative 3%. 2023, they're expecting a negative 6% as well to the top line. And we can see over the last 10 years, their top line has only really increased by around 10%. Shares outstanding, so they do return excess cash to investor pockets by doing share buybacks. 694 million in 2013, 568 in 2022. Now, ROIC, 10% or more, always try and target that for any company you invest in. It does show that management are able to effectively allocate their capital. What we can see, they have had some very strong numbers over the last 10 years. It has dipped to their lowest point last year at 14%, but 2023 is expected to be 27%, so that is pretty strong and good, gives us good faith in management. Both operating margin and free cash flow margin, they have performed very well, consistently, and what is very strong to see is their 2023 is expected on both counts to be above their all-time lows in 2022 on both margins, which were still above the minimums, so that is a good sign of this company. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, it signals two things: company's balance sheet strength as well as dividend safety. Below 3 is what we target, with these numbers showing us the minimum number of years it would take the company to pay off all of their debt net of cash on hand. 2022, 2023, around that 1.39 mark, gives us good faith that that company will continue to pay their dividend with the attractive yield, and that the balance sheet for now is safe based on the information we have. Now, in terms of the valuation, typically on the channel we do run through every single model, going through Graham's valuation, the multiples valuation, DDM model and the DCF model to get to our intrinsic value. Today's episode we're jumping straight to the end. Now, for different reasons we don't always include all 4 models. Just to make a note, for 3M, the reason why we don't include Graham's valuation on the multiples is because they are both strongly based on the earnings per share, which for 3M currently on the trailing 12 months is negative. So based on these 2 models, we have the intrinsic value, which is the average at $117, and the current price at around $106. Now, margin of safety, we start off with 10%, as we always say, if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we can see right now pretty much it is trading at a 10% margin of safety. Different investors will hold different rates of margin of safety for each company. Now, Wall Street, what do they see? Well, they see the price going up pretty much in line with our intrinsic value at around 10% to the current trading price. So in conclusion, for 3M, we believe it has around a 10% margin of safety with around 10% upside per Wall Street estimates. We then move on to the second company that investors are buying for 2024, EPD, Enterprise Product Partners. Now, year to date, it does lag behind the S&P 500 up 25%, but it is up around 8% in the midpoint of the 52-week range, again with a very attractive yield of 7.7%. Now, if you are a long-term investor, over the last 10 years, you would be down 20%, and it has been quite some time before it reached its all-time high at around $41. So let's take a look at the metrics. Well, dividend safety score 65, it is safe. 57 billion, a large cap company. Recessionary metrics, well, they increased the dividend in the last recession, in fact below average growth, but did manage to beat the S&P 500's return. Dividend growth, nice to see, above inflation increase at 5%, a bit more slower on the last 5 years at 3%, although the last 20 years keeping up at least as a minimum in line with inflation. Now, they are 1 year away from becoming a dividend aristocrat, which are companies that have increased those dividends for the last 25 years or more. Dividend yield theory, well, we can see you could argue reasonable valuation or some slight undervaluation with the current yield. And the same goes for the forward P to DCF ratio at 7.3 versus the 5-year average of 7.7. And we do see it pretty much in line with the NEG P to DCF ratio at 7.1. Now, when we take a look at the payouts, now for LMPs, we do focus on the DCF payout as the free cash flow is a lot more volatile. Below 90% is what we target, and you know what? The last 6 years, it has been pretty much below 60-65%. 2023 is expected to be around that 57 mark, so that is positive for that dividend payout for now. Now, DCF per share, it is good to see it has been increasing over the last 10 years. Some years it has dropped, but it has continued to increase over the longer term, which is a positive sign of a business. In terms of the sales growth, well, what we can see, it does show the cyclical nature of the industry. You see double-digit increases followed by double-digit negative growth, and so on and so on. So we can see the cyclicality, and it's always important to be looking to buy companies when they are out of favor, out of their cycle, to then have them increase during their periods where they are back in favor. Sales, well, how does that look? Well, this does just show that cyclicality at 47.7 billion in 2013, dropped down to 23 billion in 2016, before picking back up in 2022. Shares outstanding, now we can see they do not even share buybacks, the share issuances, which is the opposite, where they issue shares and they dilute your position as a shareholder, having issued shares of 1.84 billion to 2.2 in 2022. Now, ROIC, around 10% we can see for at least the last 5 years. Very positive to see, with 2023 expecting to be around that 11%, the same as 2022. So that is positive. More in terms of the operating margins, we can see they do fluctuate, but we can see in 2023 it is expected to increase up to 13%. Now, net debt to EBITDA, LMP's 4.5, it is nice to see that it has started to come down from that 2016 position to around 3 and is expected to be pretty much in line in 2023. So the dividend does look safe for now based on the information we have. Now in terms of the valuation for EPD, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now current price sitting around $26, intrinsic value at $38.74. If we start off with a 10% margin of safety, it looks to be a buy up to $35, at 20% up to $31, 25% still showing signs of a buy, and at 30% pretty much in line with the current trading price. Now what do Wall Street targets say? Well, they believe there is some nice room for the company to grow, as we can see, around 40%. So in conclusion, for EPD, we see around a 30% margin of safety based on our estimates and judgments, and in terms of Wall Street, they see around 40% upside over the next 12 months. Moving on to the third company, we have one that has been requested quite a lot on the channel, which investors are buying, UPS, United Parcel Services. Now year to date, they are down around 10%, trading towards the mid to lower point of the 52-week range. They offer a yield of over 4%, and we can see if this is one you have been holding, it is up 51% without those dividends reinvested, and we do see it hit its all-time high at the beginning of 2022 at around $225. Now looking at their metrics, dividend safety score at 69, it does seem to be safe. Market cap 135 billion, we are talking about a mega cap company. Recessionary metrics, maintain the dividend, average growth, and slightly beat the S&P with a negative 48% return. Dividend growth, a fairly nice story, 6.6% in January of this year above inflation, double digits over the last 5 years, double digits over the last 20 years. Very nice to see. In terms of dividend growth, well, they have been increasing the dividends for the last 13 years. Now, dividend yield theory, we can see the first sign of undervaluation, but we do see that forward PE currently sits above that 5-year average of 16, and when we compare it to the sector PE, it is slightly lower than the industrials of 19.6. Now focusing on their free cash flow payout, we do see it very inconsistent. Some years where they, in fact, like 2019, paid out more in dividends than they generated in free cash flow, although 2022 did look to come down to 57%, although do note 2023 does seem to be very high at 99%, so just something to consider. Free cash flow per share, it has pretty much doubled over the last 10 years, but it isn't without its inconsistencies, negative in 2017 and low in 2019, so we do see it go up and down, but over the longer term, yes, it is increasing, but do be aware that 2023 it is expected to drop down to 645. Sales growth, fairly nice, pretty steady, moderate growth, 3 to 7% nearly every year. We see double-digit increases in 2020, 2021. Do note 2023 they are expecting a negative 8% hit to their top line. Numerically, this is how it translates. Pretty much doubled their top line over the last 10 years, and we can see that dip to 93 billion expected. Now, they do share buybacks, not as consistently as maybe one would like, but we do see it decreasing from 948 to 875 in 2022. In terms of the ROIC, it has had some very strong years at the beginning from 2013 to 2016, but still even over the last 6 years, it is very high in the high 20s, but 2023 it is expected to dip to 20%, something to keep an eye on for the future, that this is just something that has dropped and isn't going to continue to become lower and lower. Operating margin pretty much straddling around that 12% that we like to see, 2023 at 11%. Free cash flow margin a bit more inconsistent, although we do see 9% in 2022, with 2023 expecting to drop down to 6%. So we can see 2023 hasn't been the greatest years for UPS, hence why the share price hasn't performed as well. Net debt to EBITDA, well, 0.88 from 2022. Yes, it is expected to increase in 2023. This is a company that does have a very decent balance sheet. Now, in terms of the valuation for UPS, and for those that are new to the channel or even regular viewers, if you do want to click on that pinned comment below, you can grab a copy of this valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio and on your watch list. So for UPS, we get a very high intrinsic value of $191. At a 10% margin of safety, it is a buy up to $172. At 15% up to $162. And at 20%, $153. So right now, based on our estimates and judgments, you are locking in around a 15% margin of safety. What do Wall Street say? Well, they believe the share price to go up quite high as well, at around a 20% upside. So in conclusion, for United Parcel Services, we see around a 15% margin of safety, with Wall Street expecting around 20% upside over the next 12 months. Moving on to the essential fourth company, we have Procter & Gamble company, the Dividend King. They are down 4% year to date, trading towards the mid to lower point of the 52-week range, with a yield of around 2.6%. Now, over the last 10 years, we do see it is up 77%, and it did hit its all-time highs of around $164 at the back end of 2021. Now, in terms of their dividend safety, a very safe, in fact, the highest score obtainable at 99. Mega cap company, $342 billion. And when we look at the recessionary metrics, well, they increased the dividend during the 07-09 crash, average growth, and also outperformed the S&P 500 at negative 36. This year was a pretty low increase below inflation in April, although over the last 5 years and 20 years they have had some nice growth rates. Now, two things to note here: they are a dividend king as mentioned, but they have also been increasing, or not increasing, but they have been paying dividends without a reduction for the last 133 years, a phenomenal feat for any company. Now, in terms of dividend yield theory, you could argue reasonable valuation / undervaluation, and on the forward PE we see it at 22 versus the 5-year average of 24, and when you compare it to the consumer staples at 18.7, Procter & Gamble does sit higher at 22. Now, free cash flow payout, remember below 60% is my personal preference. Some people do increase that to 70 for consumer staples. Last 2 years at 63%, 2024 at 60%, so I would like to see them have a decent increase in 2024, at least high single digits. Now, free cash flow per share, it is quite nice to see pretty consistent increases year on year. We do see 2017 where it dipped, but overall it is moving in the right direction. 2024 expected to go up to 635, so pretty positive in terms of their generating that growth to that free cash flow. Sales growth, not as great as you would like to see. 2014 to 2017 wasn't the best period for the company, but other than that, they are increasing around that 3 to 7% mark. But do bear in mind the type of company you're investing in. It isn't one that does have rapid growth to the top line. Total sales then, $74 billion in 2014, $82 in 2023. And we can see here they do share buybacks, returning excess cash to investor pockets. $2.9 billion in 2014, $2.48 in 2023. ROIC then, as we can see, not only is it above 10%, but it does seem to be increasing year on year. The last 3 years with 2024 expected as well, around that single or in fact low 20% score. Free cash flow margin, operating margin, very positive to see, above that minimum 16%. Free cash flow above that 7%. This is a very strong business in regards to their margins. Net debt to EBITDA, what I like about this is it's very consistent. They don't have years like we've seen of other companies where it shoots up and then shoots down. Pretty much around that 1.5 over the last 10 years. 2023 coming in at 1.39. So now we jump into the valuation for Procter & Gamble. And don't forget, as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos when they drop. Current price, 145. Margin of safety, as always, we start off with 10%. It is a buy up to $154. At 15%, it is pretty much a buy at current trading price. And this is one similar to 3M that I do hold in my portfolio. It is a dividend king, and they have been paying dividends for a significant amount of time without a reduction. In terms of Wall Street, well, they see the share price to go up, as we can see here, around $168. So they do see around 15% upside. So in conclusion, for Procter & Gamble, we see around a 15% margin of safety with around 15% upside per Wall Street targets. As always, don't forget to click on that pinned comment below if you do want to grab a copy of the model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list. As always, have a great day. Happy holidays to every single one of you. Hope you are having a great time with your families. Catch you on the next episode and take care.